If you still think the stock market rewards only the best businesses, this video can change how you invest forever, because one of biggest wealth creation stories in India has happened quietly and many investors still do not fully understand it. Public sector banking stock have outperformed many private sector banking stock. And this is not random, this is not luck, this is not just temporary headline. It is powerful lesson in valuation, psychology, macroeconomics and market. And if you understand this properly, it can save you from buying yesterday's winner while missing tomorrow's opportunity. So, watch till the end. For years, the market narrative was very simple. Private banks were having premium, public sector banks were weak. Private mean quality, PSU, public sector undertaking means problem, and for a long time that view was justified. Private banks were seen as faster, cleaner, more efficient, stronger in retail lending, stronger in technology, better in customer experience, and more consistent in long term compounding. Meanwhile, PSU bank carried baggage in bad loans, slow decision, government ownership concern, lower profitability, and repeated recapitalization. So naturally, the market gave private banks premium valuation and PSU banks lower valuation. But market do not reward history. Market reward change, and that is where everything turned. The first and biggest reason PSU bank outperform is this: they improved from low base. If expectations are already low, even moderate improvement can create powerful stock return. This is exactly what happened. As a bad loan cycle improved, provisions reduced and profitability became cleaner. PSU banks stopped looking like broken institution, they started looking like recovery stories. And recovery stories can be extremely powerful because when perception changes from problem to potential, valuation multiple expands. Sometimes the re-rating itself create more wealth than earning growth. The second reason was asset quality repair. For years, bad loan destroyed confidence in PSU bank. But when gross NPA decline, recoveries improves and fresh slippage remain controlled, the market start trusting profit again. This is very important. In banking, 1 rupee of clean profit is worth far more than 1 rupee of doubtful profit. That is why falling NPAs are not just accounting improvement, they are valuation catalyst. When investors believe the balance sheet is cleaner, they are willing to pay higher multiple. The third reason was lower credit cost and stronger profit conversion. Many investors miss this completely. A bank does not always need explosive revenue growth to show strong earning growth. If provision falls sharply, more operating profit became net profit. In simple language, the leak in the bucket gets smaller, so more profit stays inside the bank. That is why some PSU banks suddenly started reporting much stronger profitability. The businesses did not become magical overnight. The drag reduced. Now let us bring macroeconomics into this, because this part matters a lot. India's recent growth has had a strong public investment angle. Infrastructure spending, road, railways, power defense, government led projects became more economic drivers. When government linked capex became a major engine of growth, PSU bank naturally looks more relevant to market. Why? Because many of them have stronger linkage to public institutions, large state ecosystems, and government related economic flows. This does not mean private banks became bad businesses. It means macroeconomic environment increased the relevance of PSU bank more than market had priced earlier. But PSU banks did not outperform in isolation. Private banks also lost momentum. This is crucial to understand. When sector leaders slows down, capital starts searching elsewhere. Private banks face deposit competition, higher funding cost, pressure on margins, moderate loan growth, and in some cases, company specific issues. Look at HDFC Bank, one of India's most important private sector bank, has been digesting a giant merger while balancing loan and deposit. That does not make it bad bank, but it does mean the old easy growth story became more complicated. And when heavyweight leader slows down, sector sentiment changes. Now comes the most important investing lesson in entire video. Stock do not move only on results, they move on result versus expectations. PSU bank had low expectation and improving reality. Private bank had higher expectations and less exciting reality. That gap created outperformance. This happened in every market cycle. The biggest money is often not made in obvious quality, it is made in improving quality before the crowd fully recognizes it. Now, let us ask the harder question: can PSU bank keep outperforming forever? Not automatically, because the first phase of many PSU bank rallies came from re rating. The next phase is harder. Now, investor will demand sustained loan growth, stronger return on equity, stable margins, controlled NPA, better liability franchisee, and disciplined capital allocation. In simple words, the easy money may have come from changing perception. The next money must come from execution, strong execution. That is much more difficult. At the same thing, do not make the mistake of thinking private banks are finished. Many still have structural strength like better technology, stronger retail franchisee, granular deposits, depth, product depth, cross-selling ability, customer experience, and sharper underwriting culture. So this is not PSU good and private bad. This is market cycle rotation. Very different thing. So what should serious investor ask now? Do not ask only which sector already went up more. Ask which bank are still undervalued, which franchises can grow profitably, which balance sheets are strongest, which valuations already price perception, where the next re-rating can happen, where risk is underpriced, and where opportunity is mispriced. That is how buy side investor think. My blunt view is very simple. PSU banks outperform because they combine three explosive forces at once: lower expectation, improving fundamentals, and supportive macro relevance. Private banks underperform because premium valuation meets lower momentum. But from here, stock pricing matters more than sector level, because once a re-rating happens, lazy investing became dangerous. And remember this very carefully: the market does not care who was respected yesterday, it rewards who is improving today. That is why public sector banks surprise investors, and that is why your next wealth creation opportunity may not come from most admired name. It may come from the businesses the market is still learning to respect. Thank you very much. See you in the next video. Make sure you subscribe the channel and like the video. Thank you.